Hey everybody, welcome to this free edition of our Trader Use Group Weekly Roundup for the trading week ending May 12th, 2023. I'm Preston Brent. Thanks for tuning in. Well, this week's theme is debt ceiling debate risk, and the risks are going to start to pile on as we move through the end of this month, but more on that in a minute. Let's take a look at where we finished off this past week. So let's just get this up on the screen. You'll see that year to date, everybody is solidly in the green with the exception of the Russell. The week performance, however, was mostly flat to underwater. You can see NASDAQ's the only lone survivor for the week, up 40 bips for the week, but everybody else was in the red. Um, it was a very relatively quiet week, although the economic calendar, even though being a little bit light, we did get on the middle of the week on Wednesday, the S&P jumped a little bit in pre-market after we got the CPI data showing that it's showing that we're up 4.9% year over year. So that's down a little bit more than consensus expectations. All right. It's the slowest pace we've seen in the headline CPI for over 2 years. Core inflation, taking out food and energy, was also in line with expectations, coming in at about 5.5%. So I don't think the Fed officials seem interested in moderating their interest rate expectations as we move through the year. However, the Fed Fund Futures is still saying there's going to be count them, three rate cuts by January of 2024. I don't see that happening, but that's factored into the market right now. And should that not occur, should the Feds leave their rates higher for longer instead of starting to cut at the end of this year, the markets are going to go through a revaluation move here, which will put a little bit of downward pressure on the markets, I suspect. In fact, the markets are pricing in less than a 1% chance that the Fed's are going to keep the rate steady through the end of this year. Remember, our range right now is 5 to 5.25%. So we'll see who wins that battle. I've talked about it in prior weekend updates, but right now the Feds seem pretty adamant that they're going to leave rates where they are right now. Although the forecast of a rate cut in June is less than 10%. I mean, a rate hike in June is less than 10%. So most market participants and the Fed Fund Futures believes the Feds are going to pause in the month of June. Okay, and just one interesting stat, when the Feds begin a pause in an interest rate hike cycle, generally 12 months from that point, which would be considered June, 12 months from that point, the S&P is up, in the low teens percentage return basis. We'll see if that statistic holds true this time around as well. Okay, so regarding the debt ceiling debate, a lot of people, because it seems to happen over and over again, the politicians take things down to the end and then they start debating when you're almost out of time. But a lot of analysts and market participants believe that the outcome is probably going to be a compromise deal with spending caps, some modest long-term or near-term budget concessions, and then we'll get some kind of debt ceiling extension for another year or so. I personally don't agree with that. I think this is going to be closer to 2011. If you guys remember, in 2011, the markets fell over 15%. Moody's downgraded U.S. debt. I don't know if that will happen, but it turned into a very contentious kind of atmosphere in 2011. So we've got to consider that debt ceiling debate risk is on the table here. And the markets are discounting it right now. But this is going to start to pick up as we move through the month of May. Remember, Aunt B Yellen, that would be Janet Yellen. We call her Aunt B. Pretty much forecast the X date is June 1st. That means that date is the date beyond which the U.S. Treasury is not going to be able to meet all its debt obligations. I suspect she's a little bit premature in that. It probably won't realistically be until July, August time frame, but she's putting it out there to really spur these politicians to do something. We'll see how that shakes itself out. But you can see everybody solidly in the green year to date with the exception of the Russell. The PE ratio, the Ford PE ratio, is still higher than I would like to see. It's over 18.78. I still think the valuations are a little bit higher than they should. You're going to find some good stocks with good valuations within the S&P 500, but we're still led by just a handful, the dirty dozen. For those of you that saw that movie, I loved it. Great movie. But anyway, that's kind of what's leading the markets higher right now. They're accounting for over 80% of the earnings growth in the markets at this point in time. The dividend yield for the S&P is at 1.67, as you can see. The earnings yield is over just slightly under 5.5%. So you can see the real yield there. We're at positive numbers finally with inflation coming down. So you're earning a whopping 51 basis points on your a typical S&P earnings yield. The VIX did move up a little bit this past week to close at 1703. So keep in mind the VIX is still very, very low. About a 17% VIX really suggests the markets are going to move up or down 1% roughly on a daily basis. So the S&P E-mini futures finished at 41.32. So that would suggest an overall daily movement of about 41 points during the day. So that's where we're sitting with the VIX right now. You can see the best performing sector, and for both weekly and monthly, is still communication services. The worst is energy, and bringing up the rear, not only weekly, but year to date as well. And I will point out that these sectors were completely reversed last year. The worst performing sector last year was communication services, and the best performing sector was energy. So we're getting some of that kind of movement in the other direction based on kind of how 2022 came out. Now, if we move across the pond and we take a look at the European markets, you can see Europe was all in the red, just barely, but in the red. Year to date, most of them are double-digit returns. Okay. Now, the ECB, Christine Queen Bee Lagarde, who runs the ECB, believes that they're still going to have to fight inflation and get the rates up. Their peak right now is about 3.5%, but she believes that they could end up hiking that even further. Okay, now they're way behind the U.S. because the U.S. is at 5 to 5.25%, but inflation surprisingly is worse over in Europe than it is here in the U.S. Okay. And if we look at Great Britain, they're really getting hit with inflation. They raised their rates by a quarter point to 4.25%. And that's the highest level they've seen their interest rates in Great Britain since 2008. Okay. And they also raised their inflation forecast, calling for inflation to slow to 5.1% by the end of the year. Now, their most recent inflation reading was over 10%. So I think they're still being a little bit optimistic in their inflation cut, but we'll see how that shakes itself out. But I do believe that all of the central banks in Europe, from Bank of England to the ECB especially, they're going to have to raise their rates a little bit more. Okay. The Bank of England, they also revised their economic growth forecast. They're projecting zero growth in the second quarter. Now, that was as opposed to a prior forecast of a 70 basis point contraction. Okay, remember, all of Europe fared a little bit better than everybody thought because they didn't have as cold of a winter and energy costs did not go through the roof as much as they were forecast. It was still very high, but not enough to really damage the economy push it into a recession. But their economy is, as you can see by the markets, they're up a lot stronger on average than the U.S. economy right now. The U.K., they grew only 10 basis points in Q1, skirting a recession barely because in Q4 of last year they were a negative growth. So they just barely made it. Although GDP in March it fell 30 basis points. So they're still in very tough times, not only in the UK but over in Europe, the 19 countries that make up the ECB. Okay, and of course, if we look at the Asian markets, you can see China and Hang Seng both in the red for the week. The Japanese index, the Nikkei, is the only one hold out in the green, and I will say up 12% year to date, 12.6. That's strong for the Nikkei. You don't see it usually move like that. There is signs of strength, however, because their corporate earnings are coming in stronger than expected. So that's kind of supporting the markets. Although most investors are focusing very closely on the Bank of Japan, moving away from its ultra accommodative policy stance. Now, they just put a new Bank of Japan governor Ueda. He started last month, and he stated in his first meeting last month that he's going to leave things as they are, which moved the yen down a little bit. But he did indicate that as soon as they can see inflation sustainable and stable around 2%, then they're gonna end their yield curve control and proceed to strengthen their balance sheet. And folks, that's when we're going to want to jump on the yen. And members, I'll get a little bit more detail with you guys on that and what we're going to watch for. But we've had great trades in the yen over time, and the yen really does trend, right? Currencies tend to trend a lot better than most equities, so we're going to watch that very closely. Meanwhile, China, you can see, as I said, both in the red for the week, both in the green year to date. The Hang Seng barely in the green. They came back, if you recall, from a full week after they had a 5-day Labor Day holiday. Our Labor Day here is only one day. I wonder why they get five. I wish we had that kind of holidays, but the opening gap would be miserable, I would imagine. But we're seeing that markets pull back from their 5-day holiday. I think the investors over there are getting concerned about the strength of their opening recovery. Remember, they moved out of zero COVID in December. Okay. The latest economic data appear to support expectations that the Chinese central bank's going to ease monetary policy in the near term. They need to support their economy. You know, on the trade front, their exports did rise 8.5% from a year ago, but they were shut down a year ago, so that's no big deal. Um, Imports fell greater than expected. And with an opening economy, you would have thought imports would grow, but they're not. So that's kind of reinforcing the concerns that a lot of analysts and investors have on growth in the Chinese economy right now. We did also see their PMI data moving into a contraction territory as well. So China's going to have some growth issues, all right? What I want to do here is move you guys over to the chart. So let me get this set up here, and I'm going to move you over. Let's get you set up on the right screen here. And what you're going to see here is the first thing I'm going to show you is the E-mini S&P 500 futures. And you can see here how we've just gone nowhere, going all the way back to early April. It's just up, down, up, down, up, down. You can see the 50 EMA right below. That's going to be support. There's a support zone down here that I said would probably test. And we've tested it a couple of times. That's below the 4100 level. The E-mini futures, as you can see, closed at 4132. And the SPX closed just slightly below 4100. Okay, so that's going to be a key area right down in this area here in supporting the markets. And let me just get this off the screen here. Let's move up a little bit here so we can see a little bit more. So if you look over here, you can see the markets are running sideways. They're building up. I do believe the momentum is a higher probability of taking us lower rather than higher as we finish the month of May, because as I said before, we got that debt ceiling debate issue coming up, and that could be a doozy. All right. I mean, just really, we're going to have to see how this is going to go. But I do believe the U.S. Congress and the Republicans in there are going to be a lot more steadfast in getting more cuts. And Sippy Cup Joe Biden is steadfast in his belief that he doesn't want to do cuts. So I believe you're going to see all the negotiation happen in the last 48 hours. That's kind of what it typically happens. So we'll see how that transpires. Okay. Although I do call for a little bit of a high point up here around 4230 to 4250 over time, possibly in June, but not right now. I think it's just we need a catalyst to move the markets higher. Earnings are coming to an end, and there is no catalyst out there. And the only economic data point coming up that could really affect the markets is this debt ceiling debate. And it's not an economic, it's a fiscal policy debate. So that's why I don't think you're going to see a lot of money committed to longs near term unless something breaks on that front. Okay. If we look at the NASDAQ 100 futures, you can see it was down a little bit. We actually made a new high, and we're up a little over 22%. I got to adjust this and move it up a little bit, but very strong. And this is where the dichotomy exists. Excuse me. In the NASDAQ 100 futures, 4 stocks make up over 30 to 40%, over 40%. 5 stocks make up over 40% of this index value. And let's look at them now, mostly the FANG. If we look at the FANG index, you can see here, and I got to adjust this one too, up very high. I mean, we're up, FANG index is up over 42, 43% year to date. So I do believe this gap is going to be filled. Hang on just one second, guys. I do believe this gap is going to be filled. So we're going to have to watch very closely here. But if this comes down and we don't have participation by other stocks, then the market's going to go lower, which is what I think is going to happen over the next 2 or 3 weeks. So this is a little bit about what I'm seeing here in these markets, but let's look at the Dow. Well, let's do this. I'm sorry, I'm bouncing around a little bit here. Let's go back to the E-mini S&P 500 futures. 12 stocks in the S&P 500 account for almost 90% of the growth in the S&P this year. All right, here's the closing price of last year. Look at where we are. Over 7% up year to date. 7.41% to be exact. Let me look at the equal weight SPX. We're almost flat. In fact, we closed at 57.42. The closing price last year was 57.39. For all practical purposes, we're flat year to date in the equal weight. So that just shows you what those large mega cap tech stocks are doing to the S&P. They've accounted for almost all of the gain this year. If those stocks roll over and we don't have participation in these other stocks, we're going lower. My forecast for the equal weight is to come down much lower, all right? So we've got, should we have the debt ceiling should we have an impasse in the debt ceiling debate, then we've got a lot of downside risk. So just understand what we're looking at here over the next 4 to 6 weeks, guys, the next couple of months. Got a lot of downside risk. And if we look at the Russell index, as you saw, it's in the red year to date, okay? NASDAQ's up over 20%. The Russell is red, 1.38% down. So, guys, there's a big divergence or bifurcation in these indexes. In fact, we got the 50 EMA crossing back below the 200 EMA on the rut. So I do believe that we're going to have a little bit more of a probability of a downside action as we go through May into early part of June. Okay. Now remember, the Feds aren't forecast to hike their rates in the month of June. And the next big data point that we're going to get is really going to be the inflation in April or the May inflation in June. So with the markets quiet, they're going to be following this fiscal debate between Congress and Sippy Cup Joe. And like I said, the odds favor a downside move. If we look at the Dow, these are the Dow futures. The Dow futures closed at 33,302. Okay. So we're in the red for the year on the Dow futures. Okay. Now, if we look at the Dow, let me see the Dow Jones index. If we look at the cash index, I don't have it marked on here, but the futures are in the green, are in the red, right? So just not really good. And if we look at the Dow index, just barely in the green, all right? The futures are in the red. The Dow index, the cash index, is in the green, just barely. So we got the rut in the red, the Dow, for all practical purposes, flat to slightly in the red, and the S&P, the E-minis way up, along with NASDAQ's up double that, triple that. So a lot of issues in these markets, and we're going to get all of this stuff worked out here very quickly. If we look at the VIX, excuse me, guys, hang on a minute. Sorry, guys, I have something stuck in my throat. Teach me to eat a muffin before I do these things. So if we look at the VIX, you can see here, let's get the VIX on the screen for you guys. You can see here, it's just slowly been moving down, but we got to be very careful here because we're at that level where the VIX can just spring up like it did over here back in early May. So I'm expecting more upside in the VIX, more downside in the equities. That is where the higher probability forecast. If we look at the front month vol skew, you'll see here it's in the green. And if we look at the back month vol skew, it should be in the green as well. So well in the green here. And then if we look at the 2-8 spread, that would be the June-December vol skews. You can see we're in the green also. So the markets are not fearful going out in time. And that is because the markets have a strong forecast that the Feds are going to be forced to cut rates as we go through the end of this year. All right. That's what's propping up the tech stocks, the mega cap, growth stocks. If that changes, that's going to change the dynamics of these markets. So you heard it here from me, guys. Watch this very closely. If we come over and look at U.S. Treasuries and we look at the bond market, you can see here in the bond market, it came down, but my forecast for the bond market is basically, if you look at the Elliott wave move of the bonds, it's suggesting that we're going to move in a choppy fashion for quite some time. And remember, the bond market is saying the Feds are going to be forced to cut rates, which means the bond market is forecast to go higher, which would drive the rates lower. But it's having a hard time doing that. If we look at the 10-year rate, you can see here the 10-year rate clearly off of some of these highs up here. And the 50 EMA is crossed below, which would suggest the rates are forecast to go lower, not higher. If we do get a recession, you'll see the rates much lower, and you'll see the dollar much stronger. We'll look at the currency in a minute, but this does suggest the rates are going lower, the bonds are going higher, okay? And you can get a 90 or a 30-day T-bill for over 5% interest right now. So that hurts the deposit flight risk from regional banks even more. Okay, if we look at the currencies, and let's look at the dollar for a minute, very strong on Friday, up 66 points. Look at this. So the dollar moving up is only a sign that the economy can get worse here. So it's a safety risk, right? Flight to safety. Europe getting worse because Europe moves in the opposite direction of the dollar. But like I said, any rally in the dollar over here, we're going to look at shorting or going long the euro. And the euro is probably falling a little bit because the dollar is moving up. And you can see the euro gave up the 50 EMA. It's probably going to come down in this area here. Once it bottoms down in this area here, we're going to want to look at going long. But we've had 2 entry points with the euro where we made nice money. It came up close to my target, which was 111.65. We hit 111.21. Very close to my target, which means start taking profits up in this area here. We've had 2 entry points in the euro that we've done very well with. Okay, so now I think the euro is going to settle back down and we'll wait for another entry. Okay, or you could play the euro to the downside near term. And then, of course, if we look at metals and gold, Longer term, as you guys know, all year I've been bullish gold. Short term, just strategic profit taking points. We took profits over here. For those that got in over here, I said, don't do it. Be short gold in this area here. I think gold will pull back a little bit, consolidate, and then go higher. We came very close, as you can see. Let me just jam it up so you can see here. We came very close here. The high point in gold was done on April 13th at 2085, very close to our all-time gold high of 2089, just 4 points south of it. I think we're going to take that out easily as we move through this year. All right, that to me is an easy clip. But that's where I see gold right now. It's near term weak, but I think it's going to shore up here shortly. And then you're going to want to look for a long position. Members, we'll look at that as the markets move, as gold moves. Okay. Same thing with silver. Silver is a little bit of a higher beta move, but I think it's going to shore up somewhere down around here. And then we're going to look to go long silver. Copper, well, copper, if we have a recession, copper is going to fall off the table. We're making a series of lower highs, lower lows. So this is all the earmarks of a global economy slowing down. And remember, copper generally goes where China goes. And China, as I said, is contracting. Their PMI data is in a contraction territory. Their imports are falling. I just think this is any rally in copper should be sold short term, right? And then we'll probably find a support point down here. But at this point in time, I wouldn't be looking at copper for longs. I would be looking to sell into any rallies with copper. And of course, with energy, if we do get into a recession, oil does not favor well in a recession either. You can see we're in the red for the year for oil. Yes, last year was so strong for oil. I knew it wouldn't be able to maintain those levels. And you can see here that I think oil is going to come down to this area here. We have a way of trading oil that's a really great way to trade it, and we're making money in it. But right now, I think oil is neutral to bearish. Okay, and then if we look at nat gas, great trade for our folks on nat gas. Down in this area here, we have a great way to trade this. It's mostly neutral to slightly higher. So that's to me a low-hanging fruit trade in nat gas as well. All right, everybody, that's a little bit about where we're sitting right now. If you're not a member of our group, highly encourage you to come in and check us out. If not, members, I will see you this Sunday evening for our weekly market watch. Otherwise, make it a great weekend. And for those of you that are in Florida, our Miami Heat and the Panthers won hockey, so they're moving in the next level. And our basketball team beat the Knicks. So right on, man. Let's see what we can see where they go next. All right, everybody. Have a great weekend. I'll see you members Sunday evening. Ciao, folks.